Hi everyone, welcome back to another episode of SCAF Academy. Today we are going to talk about a very important lesson, which is accounting concepts and conventions. Without getting delayed, let's get back to our topic. So what is an accounting concept? Basically, it is the basic rules, assumptions and conditions that define the parameters and constraints within which an accounting operates. Mainly, we are going to talk about 10 types of accounting concepts in this lesson. So let's get back to those 10 concepts. The first concept that we are going to talk about is the business entity concept. According to this, the business and its owners are two separate entities. Any private and personal incomes and expenses of the owner should not be treated as the income and expenses of the business. Next concept is the money measurement concept. According to this, all the transactions of the business will be recorded in terms of money. So it will provide a common unit of measurement. For example, market conditions, technological changes, and the efficiency of the management would not be disclosed in the accounts because they cannot be measured in terms of money. Next, we have the going concern concept. According to this, the business will continue in operational existence for the foreseeable future. So financial statements should be prepared on a going concern basis unless management either intends to liquidate the enterprise or to cease trading. Next, we have the accounting period concept. In order to measure the financial results of the business, the working life of an organization is split into convenient short periods called as accounting period. So easily the comparison can be taken place. Number 5. The historical cost concept. According to this, assets should be shown on the balance sheet at the cost of purchase instead of the current value. For example, the cost of a fixed asset is recorded at the date of acquisition cost. The acquisition cost includes all the expenditure made to prepare the asset for its intended use. It includes the invoice price of the asset, freight charges, insurance or installation cost. This can be mainly for property or for an machinery. Number 6. The prudence concept. In this, the revenues and the profits are not anticipated. Only realized profits with reasonable certainty are recognized in the profit and loss account. I hope that you guys know about the stock valuation and the provision for doubtful debts. These two are mainly coming under this prudence concept. Next, we have the dual aspect concept. According to this, every transaction should have a two-sided effect of the same amount. For every debit, there should be a credit. Number 8. The realization concept. In this, the revenues should be recognized when the major economic activities have been completed. Sales are recognized when the goods are sold and delivered to customers or services are rendered. A receipt in advance for the supply of goods should be treated as prepaid income under the current liabilities. So this states that revenues are recognized when it is earned and not when money is received. Number 9. The matching concept. Here, the expenses should be recognized and recorded when those expenses can be matched with the revenues that those expenses help to generate. So in other words, expenses shouldn't be recorded when they are paid. And the final concept is the accrual concept. Revenues are recognized when they are earned, not when cash is received, while expenses are recognized as they are incurred, not when cash is paid. I hope that you guys got a good idea about the 10 types of accounting concepts. Then, what is an accounting convention? These are the common practices which are followed universally in order to record and present the accounting information. In this lesson, we will be talking about 4 main types of accounting conventions. According to the first convention, which is materiality, the immaterial amounts should be aggregated together and then recorded in the financial statements. This can include postage expenses, stationery and cleaning expenses. So therefore, these small payments will not be disclosed separately. The second convention, which is objectivity, means accounting information should be free from bias and capable of independent verification. Having invoices or contracts can help this convention. The third convention is consistency. It implies that the company should choose the most suitable accounting method and treatments and consistently apply them in every period. They cannot change time to time. And the final convention is disclosure. Financial statements should be prepared to reflect a true and fair view of the financial position and performance of the enterprise. The material and relevant information must be disclosed in the financial statements. Notes is a good example of this disclosure convention.